Hi everyone, want to talk to you today about the ultimate guide to investing cash on the sidelines. So this is a situation many of you will be familiar with. You have cash, it's sitting on the sidelines. Maybe it's in a checking account or savings account or your wallet. Maybe it's just sitting underneath your mattress, but it's earning a low rate of return. And this is money that you don't expect to need or use for a long time, let's say 20 plus years. And historically, a diversified portfolio of investments was likely to outperform cash over a 20 plus year period by a significant margin. So you understand that, but you still can't pull the trigger. You still can't get invested into the market. And you're not a market timer. So you're not saying you can get in and out of the market at the exact best time, but you have a number of concerns that are preventing you from investing. And here's a few that you're thinking about. First, you're thinking about corrections, waiting for a correction to get in. Number two, valuations. You're hearing that equities are expensive. Isn't that going to be difficult for stocks? Three, recessions. This is always a big topic, but this year it's a really big topic that everyone seems to be predicting a recession. And won't that be bad for the stock market? And finally, interest rates, always something that people are talking about. And they're talking about a lot today because interest rates have risen by a lot over the last year and stocks have gone down, and you're worried that trend is going to continue. And these are all reasonable things to be thinking about when considering investing cash on the sidelines. But what does the data suggest? What does the evidence suggest historically? That's what we're going to be talking about today. What the evidence suggests with respect to investing that cash on the sidelines. So let's start out by talking about the opportunity cost of sitting in cash. What is it costing you by not investing that cash? But first, we have to define what is cash. Is cash simply something that earns nothing, sitting in a zero interest rate checking account, or does it earn something? And for the purposes of this analysis for this video, I'm going to give you guys the benefit of the doubt and assume that you're doing a little bit of work and trying to get a higher return on cash. So I'm going to assume that you're earning the yield on the 3-month treasury bill over time. And historically, that average yield since 1928 has been around 3%. But it's fluctuated significantly over time, as low as close to 0% and as high as over 14% over time. So if you hear me talk about cash in this video, what I'm assuming is you're getting a better return than simply 0%. You're getting that 3-month treasury bill yield. So in any given period of time, what are the odds that simply investing in 3-month treasury bills would outperform a riskier investment in the stock market? Well, as you can see here, in a 1-year period, 31% of the time, actually, you can outperform the market historically by just sitting in cash. But as time goes on, those odds go down. So over a 5-year period, only 22% of the time, 10-year period, 16% of the time, and over a 25-year period, there's never been a 25-year period where cash has outperformed the stock market. So what's going on here? Well, over a 1-year period, stocks are more often than not going to be higher, but there are times when they're lower, like 2022. So more often than not, it's going to outperform cash. But as time goes on, the odds of the market going up go up, and your odds of outperforming with cash go down. But the big question is, what is it actually costing you? What is the differential between an investment in cash and an investment in the stock market? And as you can see here, in the short run, very little. It might actually cost you nothing. So you might have actually a higher return from cash. But on average, over a 1-year period, the differential is only 8%. So cash only underperforming the S&P 500 by 8% over a 1-year period. But the increases in terms of the differential are exponential over time. So over 5 years, we're talking about 53% differential, 10 years, 158%. We go out to 25 years, you're talking about 1,200% difference in returns. That's, of course, enormous. So the lesson here is pretty clear. There's an opportunity cost of sitting in cash, and that opportunity cost tends to grow significantly with the passage of time. Next, let's discuss a correction. So we hear this phrase in markets often: buy low, sell high. It's a great phrase. Certainly, you want to buy low if you can. But what is your ability to time that? What is your ability to actually buy lower at any given point in the future? And that's what I looked at here. Going back to 1928, what are the odds if you compare today to the future that you'd be able to buy in at a lower price? So let's say you just wanted to buy at any lower price in the future. Would you have had that opportunity historically? And you can see here, most of the time you get that opportunity. So 75% of the time there is a lower price for the S&P 500 on a monthly basis at some point in the future. But one out of four times, 25% of the time, there's no opportunity to buy in lower. The market runs higher and it really never looks back as compared to that starting point. So my favorite example of this, we have to talk about 1995. And 1995 was really an outlier year, but it's instructive because every once in a while you'll have years like this. And in 1995, the market ran straight up out of the gate. It's up 6% by the end of February. And if you were an investor at that time, and you had this cash on the sidelines and you said to yourself, well, I don't want to invest now. The market's just gone up a lot over a short period of time. Why don't I just wait for a 5% correction before getting in? And most years, that 5% correction would have come at some point in time. But in 1995, it just never happened. The largest intra-year drawdown that year was only 2.5%. So you never had a chance to buy in after a 5% correction. You would have actually had to wait all the way until July 1996 before that 5% correction came. And when that correction came in July 1996, the S&P 500 is 25% higher than where it was at the end of February. So the question is, for an investor at that time who was waiting for that correction before getting in, just that 5% pullback, and then it finally comes, but it's 25% higher, is that investor likely to get in at that point in time? And the answer is probably not, which really illustrates the difficulty of trying to time your exposure to the market based on corrections or looking for lower prices. But some investors would counter and say, well, I'm not just looking for a 5% correction before getting in or a lower price in the future. I want a bear market. I want a real decline before getting in. I want a significant pullback. So what are the odds that a bear market will provide a lower price than today? So you need a 20+% decline before you get in at that lower price. Well, what are the odds that's going to happen at some point in the future? Well, historically, only 21% of the time would a bear market in the future give you a lower price than today. That means 79% of the time, even when that bear market comes, it's still leaving the stock market at a higher point than today. And really a good illustration of this concept of waiting for a bear market and how difficult it can be would be what happened in 2009. So stocks bottom in March 2009, following the worst bear market, worst recession since the Great Depression. And they run pretty much straight up out of the low in March 2009. 7 months in a row, 9 months out of 10. So you end 2009 up significantly. And if you look at the headlines at the time, many people talking about stocks have just simply run too much, too fast. They're ahead of fundamentals. Wait for another bear market before getting in. Wait for that 20% pullback. The problem was, of course, that 20% pullback on a monthly closing basis did not come actually until 2022. And when it came, the S&P 500 is significantly higher than where it ended 2009, over 300% higher even after that correction. So message here from timing bear markets is pretty clear. You have to be willing to be waiting for a long time to get invested if you're waiting for a bear market, with the understanding that when that bear market comes, it might still be at a much higher level than today. So very difficult to try to time your exposure to the market based on bear markets. You may not get that lower price that you're thinking about. So up until now, we've talked about really a lump sum investment. So we assume that you're either going to invest all of that cash on the sidelines at once or simply leave it in cash. But realistically, there's an alternative. It's called dollar cost averaging. And simply dollar cost averaging, instead of investing that $100,000 today, let's say you have $100,000 cash on the sidelines, instead of investing it all today, you're splitting it up over a period of time. Let's assume you want to split it up over 12 months. That would be $8,333 per month, dollar cost averaging into the market. So every month you have a plan. I'm going to invest 1/12 of my original investment, regardless of where the market is. So sometimes it might be higher, sometimes lower. And the thinking here is you're afraid of investing that lump sum at the peak of the market. So if you dollar cost average into the market and the market goes down, well, at least you'll be get able to get in at a lower price, and you're not going to have all of those losses from investing at the peak. So it's a good concept theoretically, but in practice, how often would that dollar cost averaging have beaten a lump sum investment today? And what we find is going back to 1928, only 32% of the time would that dollar cost averaging outperform the market. And the reason for that is probably intuitive. It's simply that the market tends to go up over time, and over a 12-month period, it's likely to be higher, and it's likely to be above the return on cash during that 12-month period. So you might say, well, that's 12 months. Let's spread it out even longer. Let's spread it out over 36 months, 3 years. And how would that look versus just a lump sum investment today? Well, the odds actually go down. The odds of outperforming now are only 26%. And the reason for that is that the market is more likely to be higher over a 36-month period than a 12-month period. And if we extended this analysis to 60 months, so let's say 5 years or 10 years, the odds of dollar cost averaging outperforming a lump sum are going to go down and down because the odds of a positive return for the S&P and a return that's above cash are going to go up over time. So that's something to be thinking about when you're thinking about dollar cost averaging over lump sum. Sometimes if you have a big bear market, if we look at the early 2000s or the 2007 to 2009 period, yes, spreading that money over time will be better than a lump sum today. But more often than not, you're in this period up here where you don't get the opportunity to invest at a lower price. You're investing at a higher price if you spread it out over time. And so something to be thinking about when you're considering doing a dollar cost averaging. The odds are not in your favor, but from time to time, they do work out. But what about timing? You're thinking about valuations. Everyone's talking about valuations all the time. It's very confusing. Frequently, when they talk about it, they're saying stocks are expensive. That's something you can be concerned about. So, how do we define cheap or expensive? One way to look at that is to look at what's known as the CAPE ratio, which smooths earnings over a 10-year period of time. And this is a chart showing you that ratio over time. And where we are today at 29, it's lower than where we were last year, but still historically elevated. So we're still above the 90th percentile in terms of valuations if we're comparing to history. So today's valuation, this price to 10-year cyclically adjusted earnings, a ratio of 29 is higher than over 90% of periods historically. And that has investors concerned because we hear that high valuations are bad for future returns, and that is true on average. But what does the data and evidence suggest with respect to your ability to time that? So let's come up with a few systems. Number one, let's say that you're moving from stocks to cash when that CAPE ratio goes above the 90th percentile. So when you have really extreme high valuations. So today you would be out of the stock market because you're above that 90th percentile, and you only move back into stocks when that CAPE ratio goes below the 90th percentile. How would that have fared historically? Well, as you can see here, not that good. We actually have a 9.4% return for buy and hold, so doing nothing, so ignoring valuations, versus 8.7% had you use this timing mechanism over time. And this, of course, it doesn't take into account transaction costs and taxes, fees of trying to buy in and out of the market, which would have been huge historically, particularly when commission rates were higher and slippage was higher. And so this differential is, in reality is even wider than this. But another big problem with thinking about this percentile and saying, I'm going to get out when we have this extreme high percentile is that when the market goes above this percentile, it doesn't just have to stop right there. It can continue to run higher. That's exactly what we saw in 1995. The S&P 500's CAPE ratio goes above the 90th percentile, and then it just keeps increasing to a record high that we saw in early 2000. And what did the market do during this period of time? It more than triples on a total return basis. So the question, if you're trying to time valuation, the additional question is, are you likely to sit out this period of time, this 5-year period of time where stocks triple and valuations just keep getting more and more expensive? And the answer is probably not. This is one of the greatest bull market runs in history. And if you were concerned about valuations during this period of time, it would have been very difficult not to jump in at a higher price at some point in time. But let's change the system and say that 90th percentile on the downside is not enough. You have to move below the 75th percentile. So you need stocks to be cheaper before getting back in. Does that improve the system at all? Does it improve your return? Well, what we find is no. You still have this differential of 9.4% for buy and hold versus 8.7% for this timing system based on valuation. But true value investors might be asking, well, maybe 75% is not cheap enough. Maybe we need to lower this to the 50th percentile. And what I would caution there with is you have to then be willing to sit out of the market for really long periods of time. The S&P 500's CAPE ratio hasn't been below the 50th percentile since April 2009. Then you get to May 2009 and stocks go back above the 50th percentile, and since then they haven't been below it. And where's the S&P 500 since that point in time? It's up 6x with dividends, so significantly higher. And the key point here is that over the long run, returns in the market can still be positive regardless of high valuations. So valuations have to be really, really, really extreme before you have this situation where stock returns are actually negative. And over long periods of time, what we find is that even when valuations were at their most extreme, stocks can still have a positive return if you go out far enough. I think the best example of this is looking at the March 2000 peak. So we have this peak in terms of valuations. And yes, stocks suffered over the next 10 years. But where we are today for longer term investors to have sat all of this out because of that initial peak in the CAPE ratio, well, the market has quadrupled since that valuation peak. So over time, that growth in earnings has been enough for the stock market to still go up despite that extremely high valuation in March 2000. And for investors, their ability to time this makes it very, very difficult because even the most extreme valuation that we have ever seen in history, had you said, I'm not going to invest at that point in time, well, 20 years later, you're still significantly higher. So if you have a really long time horizon, and we're talking about here cash that's not going to be needed to be used for 20 plus years, regardless of where valuations are, you're likely to see a higher return for the market over the next 20 plus years than cash. So what about the economy? What about recessions? What about this idea that the economy is going to a recession this year? Many economists are predicting that. And historically, what we find, if we look at this table of bear markets, is that recessionary bear markets tend to be deeper. So you tend to see over 40% decline on average for bear markets during recessions versus less than 30% for bear markets that are not associated with recessions, which brings up an important point. Do all recessions actually lead to bear markets? So you're worried about the economy, worried about a recession, but actually there's been a few instances where you haven't had this 20% decline during a recession. We had it in 1945 with not a significant decline at all. It was very small pullback. 1954 and 60 and 1980, all less than 20% declines in the S&P 500. So historically, you don't have to even have a bear market with a recession. But let's say you were the world's best economist and you're able to time perfectly the start and end of every recession going back in history. How would such a system have fared versus a buy and hold in the S&P 500? And what this illustrates in this table here is that had you been able to predict the exact start and end of every recession going back to 1928, you would have had a return of 10.7% versus 9.4% for buy and hold. And that seems pretty good on its face. But if you dig into the data a little bit, what you'll find is all of this outperformance was from the avoiding the bear market decline during the Great Depression. And if we exclude the Great Depression, what we see is actually lower return had you timed every recession after the Depression perfectly than a simple buy and hold. But in reality, I think we have to look at other scenarios because the world's best economist doesn't exist, and no one could predict the start and end of every recession with exact perfect timing. What if you sold a year before the start of a recession and bought back in a year after, or sold 6 months after the start of a recession and bought back a year after? What you see here is a much lower return than buy and hold in all periods. And again, important point on this table is we're not taking into account taxes, transaction costs. So if we included that, especially during years like the Depression when transaction costs were enormous, we're going to have a much lower return than a simple buy and hold. And the question you might be asking is, well, why is that the case? Why is it if you could predict the start and end of every recession and avoid a lot of those some of those bear markets, why is that the case that you can't outperform a simple buy and hold? And the answer is that the stock market is not the economy. And what that simply means is the stock market is a reflection of many different things. The economy is one of them, but the stock market doesn't move in tandem with real GDP. And so the stock market often peaks before the start of a recession, and it often bottoms well in advance of the end of a recession. And that means that simply predicting when a recession is going to start and end isn't going to be that helpful because the stock market can be moving up well in advance of the end of it and could be going down before the start of it. And so historically, if you had said to yourself, well, I'm in a recession already, it feels like a recession, maybe it's even a recession has been declared officially by the NBER. Why not wait until things get better? The news is better, the economy is better. And I think this table illustrates clearly why you shouldn't wait for the news to get better during an actual recession. It's the fact that by the time the end of a recession is announced, the S&P 500 is often well above the level, so the low. So 61% on average, looking at the last a few announcements for recession dates, end of recession dates versus the low of that bear market. So as Warren Buffett said during the 2008 bear market recession, if you wait for the robins, spring will be over. And what that simply means is if you wait for the news to get better, your ability to buy in at cheaper valuations and take advantage of lower prices is going to be gone. So keep that in mind, additional factor in trying to time your exposure to markets during recessions. And finally, let's talk about interest rates. So we have interest rates over the past year rising significantly. It went up from 1.52% at the start of 2022 to 3.88% at the end. That was the second biggest increase in the 10-year yield that we've ever seen in a calendar year. What many assume is that there's an extreme negative correlation. Like stocks were down a lot in 2022 and interest rates were up a lot. And therefore, the two are one and the same, that every time interest rates go up, stocks go down and vice versa. What we find actually historically, though, is there's almost a 0% correlation between changes in the 10-year treasury yield and changes in the U.S. stock market. If we look at the average one-year returns for the S&P 500 during periods of rising 10-year yields versus falling 10-year yields, we actually see on average a slightly higher return, but no meaningful difference. Right? Interest rates, regardless of their direction, up or down, the stock market tends to be higher over time. And if we dig in and look at the actual 11 largest increases in the 10-year yield in any calendar year, what we find is that 9 out of those 11 years, the stock market is higher. So yes, in 2022, the S&P 500 was down at its largest decline since 2008, and interest rates rose a lot that year. But in almost all of these other years, interest rates were up a lot, and stocks were actually still up a lot. But what about longer periods of time of rising interest rates. So a lot of people are worried that this is just the beginning of a long period of interest rate increases for the 10-year yield. Well, let's look at this period from 1949 to 1968. Interest rates rose from 2.32% to 6.03% over this 20-year period. And what did stocks do? They were up over 1,500%, 14.9% annualized. So actually above the historical average during this huge period where interest rates were rising. And the lesson really here is that it's not that the direction of interest rates don't matter at all. There are certainly times where rising interest rates can cause problems for the stock market and cause the economy, cause difficulties in the economy. But more often than not, it doesn't tell you everything you need to know. Like interest rates could be rising for any number of reasons. It could be a good thing because people are expecting higher growth rates. So you have to dig into exactly why interest rates are rising and falling, and then predict what the market's reaction is going to be. And historically, that's been a fool's game to play because you can't do that because the stock market tends to rise over time, regardless of the direction of interest rates. So whether they rise or fall, you tend to see higher stock market returns. And the longer period over which you're considering, the more likely the market is likely to be up regardless of the direction of interest rates. So let's sum up here. Investing cash on the sidelines. What have we learned? Well, there's really no easy answers. There's no 100% this or 100% that in terms of what to do when you have cash on the sidelines. Investing is really a game of probabilities. And the probabilities up until now suggest that there is an opportunity cost to cash. There is a cost to keeping that cash in a lower yielding vehicle, even 3-month treasury bills giving you the benefit of the doubt. There's a cost to that, and that cost tends to go up over time. So you might be wondering, should everyone just close their eyes and invest a lump sum today and forget about the rest of it? Well, yes, theoretically, based on the probabilities and evidence, you would be better off most of the time from just investing that cash that you don't need and you're not going to access for 20 years into an investment portfolio. But what's true in terms of the evidence and data doesn't matter if you can't stick with that portfolio. So investing is about psychology more than anything else. And if you can't sleep at night because you just invested a lump sum into the market and you're worried about this being the top, any number of other reasons, well, then that higher return you won't be achieved. So you won't be able to stick with that portfolio long enough to actually get that higher return. So really what you need to do is find that portfolio, find that plan of investing that cash where you can stick with it over time. And I think that if you're not going to have to use that cash for 20 plus years, there should be a pathway, there should be a portfolio and a plan that would allow you to at least invest some of that cash that's sitting on the sidelines to get a higher rate of return. You just have to find the one that you're going to be comfortable with, you're able to stick with over time. Now, throughout this post, this is an important point. I've assumed a 100% portfolio in the S&P 500, so all U.S. equities. But in reality, many investors would be better served by having a more diversified portfolio in terms of asset classes and your likelihood to stick with the portfolio. It's going to go up if you match that portfolio with your risk profile. So 100% investment in the S&P 500 is maybe too risky for a lot of people, and you'd be better served by having some combination of the S&P or other stocks and lower risk investments. So at the end of the day, the most important thing for investors to do is to find that portfolio that they can stick with long enough to reap the long-term enormous benefits of compounding. So hopefully this video was helpful in you thinking about investing some of that cash to achieve a higher long-term return. And for more content, take a look at the other videos we have on the channel. Subscribe to the channel. Hope you enjoyed this and this was helpful. And there's going to be a lot more content here to come. So thanks everyone for joining, and I'll see you next time.